after 2 days of discussing and planning for the future of our cities, we move on with a very logical session that focuses on how we're going to pay for all of this. Here to lead that discussion is Ms. Adrianne Kadzinski. She's the Managing Director of Structuring Strategic Capital, and her panel of experts who are going to give us a preview of how financing for urban projects is going to evolve from now through 2050. Adrianne?
Should I take this podium? Good enough. Great. Good afternoon. Very excited to be here. I'm someone who's worked for a long time among the different worlds of institutional finance, government, and entrepreneurship. With me today, I have three distinguished and very exciting speakers. Chris Jones is an expert in regional urban development policy. He is Vice President for Research at Regional Plan Association, where he directs economic, housing, transportation, and urban development research. Since 1922, RPA has surveyed, analyzed, planned for, and overseen implementation of the future growth of the tri-state region, which, for those of you who aren't native to New York, that's New York, Connecticut, and New Jersey. Furthermore, RPA conducts groundbreaking research into issues of land use, transportation, the environment, economic development, and opportunity. RPA plays a critical role in fostering truly long-term strategic thinking and implementation. Prior to joining RPA, Mr. Jones was the special assistant to the deputy mayor for planning and development in New York City. Josh Wilkes, sitting on the far right, is one of the most knowledgeable people in the country about the municipal bond markets. He's portfolio manager at Pine River Capital Management, a global alternative asset management firm with over $15 billion in assets under management. He's responsible primarily for Pine River's municipal bond investments. Prior to that, he was managing director and head of Deutsche Bank's corporate investment grade credit and municipal bond trading desks. And then our third speaker is Dylan Hixon, a venture capitalist, president of Arden Road Investments and head of a family investment office. He has particular interest and expertise in some of the technologies that make cities secure and sustainable, as well as great interest in the policy implications of our needs and choices as consumers and citizens. He is also a member of the executive committee of the Regional Plan Association. So since our conference and the American Geographical Society are based here in New York, I thought we would focus on the urban development needs of New York City and its critical surrounds, the tri-state area. We'll start with a brief overview from Chris Jones of what the future may portend for the city and its surrounding states. We cannot forecast out to 2050, but we can take a look at the roads that may take us there. Then we'll go into a discussion of some of the financing of infrastructure with Josh Wilkes, who can speak to some of the dynamics of the enormous US public market for municipal and infrastructure bonds that makes all of this possible. And then finally, we'll discuss the role of entrepreneurship in generating innovative solutions to the needs of cities and the dynamics of early stage angel and VC investing with Dylan Hixon. And then we'll save a little time for questions at the end. So with that, I'd like to turn it over to Chris Jones, who's going to give us a brief slide presentation.
Great. Thank you, Adrianne. And I just want to say I'm delighted to be here. I feel like Regional Plan Association and Society are kindred organizations that should be having conversations long before this. We're both very concerned with place. We're both very concerned with, the long-term development, and that's a relatively small club, it feels like in some times, but obviously critically important. So we had our start back in the 1920s when the New York region was, New York City had just, come together as the 5 boroughs, but already it was bursting apart at the seams. And a number of enlightened business leaders in New York put together the first regional plan in the country, which has been a model for others around the world and around the country. And about every generation or so, we step back and we really take a comprehensive look at what we think the future direction of the region holds. What are some of the critical issues that we're missing? And we really develop what we feel is a blueprint for action over the next 25 years. So the last time we did it was in the early 90s when New York was, was really, there was great concern that the city would actually maintain its place in the global economy. We had several recommendations for infrastructure investments, like the Second Avenue subway, connecting the Long Island Railroad into Grand Central Terminal, things that actually happened over the last 25 years, and we felt really kind of got the region off on a good long-term foot. So we're looking at looking out now. We have our target year as 2040, but we're certainly looking beyond that, because we know if you're looking at issues like climate change or infrastructure investments that last 100 years, you really have to take a much longer-term view than that. So, forecasting is a very dangerous business. I think when the first regional plan came out, it came out about a month before the Great Crash in 1929, and it was forecasting that the region would like double its population over the next couple of decades. That didn't happen, but still the recommendations in there did set the stage for a few decades of growth after that. So what are we looking at here in the future? Well, there's some things that we can really put our money on. You can really bank on the fact that we're going to get a lot older. No matter what type of population projections you use for the New York region, people over 65 are going to be anywhere from 2/3 to 3/4 of the growth, just because of the way the baby boom generation is entering their retirement years. That also means we're going to have a much smaller workforce. People in their working age are going to shrink, so you have fewer people supporting a larger dependent population. That's certainly a national issue, and in much of the developed world, but it's certainly a very acute issue for planning for the future of a metropolitan region such as New York. We know that we're already a very diverse place, racially and ethnically, and we're become even more so. By 2040, will be not only the city will be a majority non-white place, but the entire region will be as well. We know that the places that we have to grow, that there will be a lot less, there'll just be a lot less of it. There is, much of the growth that we've seen, certainly in the post-war period, and even in the last 20 years, were in greenfields or places that were relatively easy to redevelop. That's not going to happen. We know the infrastructure is aging, and we know climate change is kind of the game changer that and sea level rise is certainly something we have to factor in. Then there's a whole bunch of things that we make our best assumptions about, but which are a lot less certain. Growth in the national economy, whether the millennial generation is going to continue to flock to cities, or whether they're going to return home to to where they grew up in suburban locations. We know that there'll be sea level rise, but we don't really know the frequency and intensity of storms and what that's going to do. So there's a number of things that we factor in here that we say here's the general direction things are headed, but we don't really know for certain. And how do you figure that into looking for the region's future needs? Well, we've done it through a scenario planning exercise where we've looked at how these assumptions could play out, not only externally, but what type of choices can we make individually that will really affect that growth, whether those are land use regulations, whether it's how we incentivize housing, what type of infrastructure we build. And if you look at how much we've grown in the last 25 years, we added about 2 million jobs and 3 million people. And that was actually pretty good by historical standards. Through most of the post-war period, the New York region was losing share to the rest of the country. Over this period, it stabilized and it was holding its own. New York City, in particular, came back as a place to grow, and that population growth, supplied even more labor force growth, with women entering the labor force, strong immigration to the region, and factors like that. But if you look at what, how much growth is likely to occur in the future, if we continue making the same sorts of investments and the same sort of policies that we're doing now, we would expect about half the level of growth as what we've had in the last 25 years. A lot of that has to do with the changing demographics. That with the smaller labor pool, you have there's less job growth, but also a lot of it has to do with just how much housing you need to create and how much housing we're creating now. There'll be smaller households, which means you need to build more new housing. There's less land to build it on, so we're really looking at not only kind of external factors which might hold down growth, but constraints both on infrastructure, housing, and economic development. But that's only half the story. If you really looked at how much demand there is in the region, how many people want to live here, the types of businesses that want to come here, looking at some, national economic forecasts and some regional forecasts done by, some prominent firms like Moody's Analytics, we think this is the potential that the region has to grow over this period. About twice as much as it would if we just continued with the same level of policies, but really not that dissimilar to what's happened in the last 25 years. But there would have to be a number of very significant policy changes. We'd have to increase our housing production, for example, by about 50%. We would have to make a number of critical infrastructure investments, not just to transportation, but to water, sewers, and the rest. And if we want to do it in a way that is both sustainable and that also expands opportunity to the poor and people who've been left out of much of the prosperity that's been happened over the years, we would have to not only be concerned about the level of growth, but the type of growth, where it is, what type of communities it creates, what type of access people have to different types of opportunities. So we then took a look at different scenarios that we thought could, both accommodate this type of growth and also achieve some of the objectives that we're trying to promote and that you hear. Whether you do a focus group or a survey or just talk to your neighbor, everybody is concerned about how expensive it is to live here. There's concern about climate and what would happen, with any number of breakdowns, whether from technology or terrorism or the rest. So we're trying to look at not only how could we accommodate growth, but how could we do it in a way that would achieve the most the greatest good with the greatest feasibility and least cost. So what we did is we mapped the region using different place typologies that we constructed using different variables from density to land use entropy to other types of urban form to look at kind of the basic types of places that we have in the region and how they performed in the past. And these 5 categories that you see here, there are 16 subcategories under here. So we use these as the building blocks for different types of growth scenarios that we could have. The first type is obviously the dense urban core of the region, not just Manhattan and not all of just New York City, but certainly parts of Brooklyn and Queens and the Bronx, but also northern New Jersey and some of the, from Jersey City to Newark and some of the more, intensely developed parts of the region. The other downtowns and local centers that are outside of the urban core, these are the White Plains and the Stamfords, the Newarks of the world. Some places that have done well, some places that haven't, but really the places that have the infrastructure to accommodate a good deal more growth. If we can solve the myriad issues that have been restraining growth in these areas. The whole commercial and industrial makeup of the region. Interestingly, these are the shopping centers, commercial strips, industrial parks, which have accommodated a surprising amount of population growth in the region recently, and we think have actually a great deal of potential to absorb quite a bit of the region's additional growth if we can really remake these places in ways that work from a transportation perspective, work from an urban design perspective. Many of them really serve as the downtowns of outside of New York City now, and we think that they can be made much more functional if we adopt the right policies for them. This is the kind of the suburban residential makeup of the region. It occupies obviously a large part of the land geography of the region, but still largely pretty developed at this point. And the vast amount of open space, both protected, unprotected, and agricultural. So we looked at 4 different ways that you might, address growth in this region, and we really feel as an objective that to try to accommodate as much of the demand as you can sustainably take in is actually a good policy to pursue. It's very difficult to solve issues of poverty without having growth in the economy. It's very difficult to provide the amount of housing affordability that you can if you're not creating enough housing to meet demand. It's very difficult to generate the revenues that you need to support, whether it's infrastructure investment or education or whatever those policies are. So we looked at 4 different ways that you could do it. One is really looking at the natural systems of the region, our waterways, the ocean systems, the parkways, et cetera, and actually trying to see if you can use that as an organizing principle for growing the region, protecting as much sensitive space as possible, keeping as much out of the floodplains as we can, which really intensify development in the core. Reinforcing the center of the region, that's a continuation of what we've seen in the last 10 years, with New York City absorbing the largest part of the job growth, but population really being distributed in other parts of the region. And then resurgent downtowns, that's our prescription for really bringing back places back to, their historical peak in population, making places, such as Newark, or Bridgeport, centers, rather than of the economy, rather than outposts of the economy, and as well as smaller places, in villages around the transit network in the region. And the last one, reinventing the suburbs. We do feel that there are ways to accommodate growth in the suburbs that, is the antithesis of sprawl in a way. There is enormous, capacity in village centers in much of the suburban landscape. The commercial corridors that I talked about are an opportunity, but really in order to do that, you would have to fundamentally remake the transportation systems of those areas. You would have to, really fundamentally change land use and housing policies in these areas. So all of these kind of push the envelope in a particular way, so you can see what are the benefits, where do we push up against questions of feasibility, and our next step is to really look at what are the ways that we can both try to combine the best features of these different future alternatives. What are the implications for infrastructure investments and land use policies? So I just want to show you, just one of the diagnostics we've done. We've done several so far, but it really makes a big difference in terms of how you grow, in terms of what types of infrastructure investments you're going to need to make. We're going to have to make heavy investments in infrastructure no matter what, even without the robust growth we're talking about here, and even with this type, it's very different types of investments that we need to make. So for example, this one, the scenario that reinforces job growth in New York City, you would really have to greatly expand capacity into the Manhattan core, whether it's through the commuter rail lines, or other systems into the dense core of the region. Some of the other ones, you'd have to make heavy transportation investments in other areas. You might have to remake the commuter rails to serve some of these outpost downtowns under the third scenario, for example, or look at demand response systems in the suburbs as a transportation solution to those. So these are so we just kind of want to put this out there as a way of thinking about what the infrastructure needs are and how we finance them. It really depends on the type of future that we think is going to happen, how much flexibility we want to build in if assumptions play out differently, and what type of future we want to create, because much of this is actually intentional decisions on the part of citizens and political leaders in the region. So, thank you.
So thank you, Chris, for that great introduction. And my first question for you, and it's probably not entirely a fair one given that you haven't published yet, but if you could identify what are the most critical needs that have to be financed for, because really we're taking a look at something that's going to take to roll out over the next 35 to 40 years. But then the follow-on to that is if you're thinking about what is the thing that will be the most transformative effect for the city or for the region, what would that be as well?
Yeah. So I'm going to start with the basics. I mean, that's, you can't even look at, kind of the transformative infrastructure until you solve the problem of financing the basic maintenance of the system. The MTA, for example, has about almost a $50 billion backlog in state of good repair that they're kind of slowly working their way through. We spend much less in infrastructure both as a country and as a region.
Sorry, I just want to interrupt for a second.
Yeah.
For the MTA, for those of you not from New York, is the Metropolitan Transit Authority. It runs our subways, public transportation, et cetera.
Right, thank you.
Sorry.
No, that's a good reminder. So we have, we're falling behind places like London that are investing, heavily in transit, housing, et cetera, for it. So there's a couple of things. I would say, one, just really using technology to make better use of what we have, and a simple thing like putting all of the subway trains in New York City on communication, what's called communication-based train control. It's basically just a digital system to operate the trains. Most other systems in the country are doing that. Our signal system was invented by Thomas Edison and put in place around 1900, and it's still in use. And they are starting to transform the system, but at the current rate of investment, it will take another 50 years to do that. So we need to accelerate it. And then there's the two other things I would say is that there is kind of one critical piece of infrastructure, creating a tunnel, a new passenger rail tunnel between under the Hudson River. The one system that is the Northeast Corridor and much of the commuter rail system in the region is probably needs to be shut down within a decade. And if we don't build some redundancy in that system, that will shut down not just the economy of this region, but the economy of the whole Northeast. So out there.
Okay. And so then for those basic needs, then if you are thinking about 2040, 2050, what is that? What does the city look like at this point, assuming we've met the basic needs, which is a very large assumption?
Right. What does the city look like in terms of?
In terms of what next? What should we be thinking about next?
Mm-hmm. Well, I actually think that the infrastructure problem is a political problem. It's how we finance things that will not be in place for another 10, 15 years in the future in some cases. And convincing the public and political leaders that these are investments that we need to make now, even though we're not going to see the benefits of them 10, 15 years into the future. So we really have to look at kind of the institutional mechanisms that we're using to fund some of these. It takes so long to put projects in place and they end up over budget so often that we lose kind of political credibility to finance them. So I think we have to look at the cost side, how to reduce, how to deliver projects more quickly. Again, there are other places around the world that have done some of these. And I also think technology can play a role in some of the financing pieces of this. There's mileage-based user fees is something where you're just through your GPS tracks how much you drive and has a small charge on that. So I think that's there are pieces like that can kind of weave the financing into the fabric of what people do on a daily basis. So, but I do think it's political and institutional at the core.
And this, I don't know if you have this fact or figure at your command. It may not be a fair question, but just to scare the audience a little bit, can you describe what the funding gap is between what we need and where we are right now?
It's a great and fair question. I don't have a single dollar figure for you, but I would say, back of the envelope estimate, if the if the MTA has a $50 billion backlog and a new Trans-Hudson Tunnel would cost up to, $20 billion, and we haven't even talked about climate change.
Right.
And climate resilience, we're easily, talking at $150 to $200 billion, I would say.
Right. And that's purely right now you're talking about transportation. You're not addressing the other needs of the city.
I was trying to kind of figure in some of that into it too.
Okay.
Yes.
So that's a pretty big gap. One of the other questions I had for you also is, particularly since you're dealing with the tri-state region, what are some of the challenges of infrastructure and finance as you're crossing state lines and or federal roles and responsibilities, if you could describe that to the crowd?
Yeah, I mean, I think that's one that, well, first of all, every kind of city or region in the country faces that to some level, kind of the difference between, kind of local, state, and federal responsibilities for these, different funding streams. We have a particularly intense problem here since we cut across 3 states, and we need to get, for many projects, we need to get consensus among all of them. And that's been the whole delay with the, with the new Trans-Hudson Tunnel. And I'll just use it kind of as a very brief case study for how this plays out. The one bi-state agency we have, the Port Authority of New York and New Jersey, has, it reports to each governor, the governor of New York and the governor of New Jersey, so they both have to agree on something that gets built. This new tunnel is partly a federal system, since it's the main conduit for Amtrak on the Northeast Corridor. They have known for, probably since the early 90s that this was a really critical piece of infrastructure that needs to get built, and it hasn't happened yet, and there is still no approval, and part of it is that there is just there's no clear sense of responsibility for, who really has to, be the central, agency or political entity to build it. And coming to consensus around, not just the funding for it, but what type of project it's going to be has been a real barrier over the years.
I can give a little personal color on that. I actually lived in Chelsea during the period that they were dynamiting the tunnel 24 hours a day. And so there were a number of residents in our building who didn't get any sleep for 3 months. But it was also a signal of the urgency and the amount of time that we were running out of that drove that schedule. So I think, thank you, Chris, again. That was a great introduction that really, I think, sets the stage for the question of how do we pay for all of this? So repairing and replacing aged infrastructure, building new and smarter infrastructure, that all takes enormous money, as we've heard. The US is very fortunate, though, that we enjoy an enormous liquid public market that's capable of financing these enormous investment needs of our cities and citizens. And so the enormous size of the US municipal bond market gives us an incredible alliance of public and private. As a little background history in the municipal bond space, the first official muni bond was actually issued by New York City to finance a canal. And the local municipal bonds were issued to finance railroads. And the American Geographical Society obviously played a critical role in that, in mapping the country for the railroads and the government. So my first question to you, Josh, what is roughly the size of the US municipal bond market?
3.8 trillion.
3.8 trillion, okay. So that's a decent number.
That used to be a big number.
I know, right now it seems like chump change, right? And then if you can describe for the audience a little bit, I mean, many of you are probably familiar with muni bonds. You probably have them in your portfolio because of their tax exempt status. But if you can talk about the difference between general obligation and revenue bonds and what that means,
Sure.
would, I think, be helpful.
Sure. I mean, most people, when they think of the municipal bond market, they think about cities and states, and that's a good chunk of it. But there's a very large portion of the market that's agencies, authorities, things like the MTA, subways, the Port Authority, bridges and tunnels, and it really spans over many different sectors. There's public health care, there's public power, there's affordable housing that's tax exempt. But basically, this country, a long time ago, it's probably about 100 years ago, decided that rather than having all these projects come to political leaders and ask for a handout for each project, they decided to create a subsidy in proportion to the size of the transaction. And so as long as it was qualified as a public use and they put it onto bond councils to say, yes, this qualifies. It would just get this subsidized borrowing. So you could argue whether or not if something is issuing twice as much debt, they should get twice the subsidy as the next project. But there's a way to kind of just push it out of the decision tree, and perhaps it was more efficient, given the possibility for corruption or favoritism. Maybe it's a way to be more fair. No other country has followed in our footsteps to create a tax-exempt bond market. A lot of countries have studied our markets, and they've borrowed a lot from our markets. In most of the world, infrastructure was originally funded through banks, and the capital markets are deeper, and it's a better way to match up need for investments with need for savings, basically. And especially some of these institutions, insurance, mutual funds, they want very long-dated assets, more so oftentimes than banks. And so it makes particular sense to use the capital markets, but I find it interesting that no other country has followed our lead in making it tax exempt. Or frankly, if I were going to invent the municipal market from scratch, I would probably lean towards a taxable method. The government created a Build America bond program during the crisis, and it was very well received, and to my mind was a more efficient way to finance the public sector, because a subsidy went directly to the cities and states and authorities in proportion to what they borrowed, whereas with tax-exempt bonds, a lot of the subsidy goes to the investors. And that's why if you're making a fixed income investment, you're probably going to look at municipal bonds very favorably, because after tax, they look a little bit cheap usually versus other comparably credits in the tax world, which means that you're getting a benefit that the cities and states aren't getting. So we do have a very deep market. It can finance quite a bit. All these needs are very financeable as long as the projects make sense. I think from a policy standpoint, it makes sense to bring back the Build America bond program and have a mix of both. If you turned off the taps on tax exemption, all the existing tax-exempt bonds would rally, the yields would go down, and so that would be an opportunity to issue more. It would be a windfall for the people that own them, so it kind of makes sense for issuers to get some of that benefit. So I think a balanced approach. But to answer your original question, you've got authorities, you've got public power, public hospitals, and it makes up a broad market. So when people say they're investing in municipal bonds, you really have to do a little bit of work, and the credits are very different across of them. On average, the credits are very, very safe. So the cumulative 15-year default rates for investment-grade municipal bonds is under 1%. It's about 1/5 of what it is for corporate bonds. And most of those defaults are actually little teensy corners of the market that most people wouldn't see. I can bore you with all the little nooks and crannies of the municipal market. So if as an investor, if you invest in some big name project that's investment grade, you probably are looking at a much lower chance of default than a comparably rated investment in almost any other sector. So it's a safe market. It's very deep, but whether it's the most efficient way we could do it, I would argue that tapping the global taxable markets, which are even larger and deeper, would make a lot of sense.
That's actually a pretty interesting point. There is a country that's actually in the process of developing their muni bond market, and that's India. So that could be an interesting experimental lab for what you're talking about. So 7 years in after the financial crisis, what is the state of health of the muni bond market? It sounds like it's quite healthy. How was it affected during the crisis? Right. And what happens when a city like Detroit files for bankruptcy? What is the effect of that as it spreads through?
Right. Well, 2008 was a traumatic year for the municipal market, much as it was for most of the different asset classes. And municipals followed corporate bonds rather closely. Treasuries rallied, municipal bonds and corporate bonds sold off. They went in opposite directions. There was a flight to quality. And they both snapped back in 2009. The municipal market was roiled by, you might have seen the press around, a research analyst, Meredith Whitney, made a very bold proclamation in 2011 that the whole sector was very, very perilous, and due primarily to pension issues, which are, she was right that there's very large issues there, but she was wrong on her timing, and she was predicting very large defaults. People in the municipal market had very high conviction that she was wrong from a trading perspective, but it spooked the general market, and so that roiled the market for several months. It came roaring back. Then fast forward to 2013, what a lot of people call the taper tantrum, when the Federal Reserve was testing the resiliency of the market to allow for rates to go back up, and the market pretty much failed the test across all different asset classes. So again, municipal yields got quite choppy and took about 6 months to recover, which was more than some of the other fixed income markets. At this point, the municipal market is very, very, very strong. It started the year a little bit weak, having rallied a lot last year, and then the second half of the year it started rallying, and it's been a bit of a bond grab as the calendar for new issues has underwhelmed people. The new issue calendar every year is around 300 to 400 billion, and there were many calls that this fall will be a very heavy issuance, perhaps predicting that issuers would want to get ahead of potentially rate rises from the Fed. What I think a lot of people get wrong is that just because the Fed perhaps raises rates, and the bet is that they'll raise maybe 25 basis points in December, short-term rates going up doesn't necessarily mean that 10-year rates or 30-year rates also go up. It could be built in, as you'd expect. It would make sense for it to be built in. If there's conviction that that's going to happen, why wouldn't it be built in? And the calendar really didn't materialize, and so the state of the municipal market now is very, very strong. We could issue multi-billion-dollar deals, and they'd be many times oversubscribed. So there's quite a bit of demand for municipal bonds right now.
So it really sounds like it boils down to what Chris described earlier. It's a political problem more than a financial problem.
Right. If there's a project that makes sense, and if the projects have to make sense, there's a project that Bank of America has been trying to bring to market for several months now to build a rail project between Miami and Orlando called All Aboard Florida, and that deal hasn't financed as many bonds as they had hoped, and they've done a little bit, but they wanted to do over $1 billion. And that project, I think investors in general thought that the number of passengers that they're projecting would want to use this rail was aggressive. And so the projects have to make sense to people, but people know what makes sense, and most of the deals that are brought to market, everyone agrees it makes sense. It's just a matter of very fine-tuned levels of should this borrow at 3% or 3.1%, and that's what municipal finance professionals obsess over. But whether it can be financed, there's quite a deep amount of cash to finance these projects.
Right. So that's good to hear. I mean, it's certainly having a deep absorption capacity really turns the question back into then politically, structurally within the system, what are the impediments? So you've answered my question to some extent that I'm about to ask next, which is you talked a little bit about the Buy America bonds, but where do you see the muni bond market evolving in the next 5, 10, 15, possibly even 35 years? And what needs to be done to make the Buy America bonds and changing some of the tax exemption status a more viable program? Right.
Well, to my mind, the Build America bond program was very, very successful. What they did was rather than have a bond that's tax exempt, and so an issuer would borrow at 5% instead of 6%, they would have the issuer borrow at the 6%, which is where a taxable investor would buy it, and then they would give that 100 basis points or there was a 35% subsidy directly to the issuer.
And for those of you who don't know what a basis point is, 1 basis point is 1/100th of a percent. So 100 basis points is 1%.
Right.
Sorry.
And so the advantage of issuing the taxable market is that suddenly a lot more investors can participate. So global investors that don't pay tax in the U.S. can participate. Pensions that are not subject to tax can participate. And it's just a much larger market that those investors hadn't oftentimes looked at the municipal market because the yields were too low because of this tax exemption. And so I think where the market will eventually go is I think at some point the question of this program will be a little bit less politicized because it became associated with an Obama program. And at some point they'll bring it back for a portion of the financing. So if there's 500 billion of issuance every year, maybe 100 billion will be in this program and 400 in the tax exempt, or maybe they can fine tune it so that you're optimizing the minimal cost to the cities and states and authorities that are issuing. That would be a more efficient way to finance than all Build America bonds or all tax exempt. If you had to choose one or the other, all Build America bonds, to my mind, would be more efficient for the public sector, but it's unlikely because the country doesn't like changing tradition like that. Everybody has,
It's difficult to explain.
They're spread over. People like the tax exemption. People that aren't happy with taxes, and who
I don't know
likes to
anybody
pay
who's
tax,
happy with taxes.
likes the fact that they've got investments that don't pay it. So I don't actually predict that we'll ever get rid of our tax exempt market, but I think we'll augment it by having a portion of the funding needs tapping these other global pools that we're not tapping for the public sector, because there is demand for long-dated quality assets, and we have them, and we're not tapping those investors because tax exemption only benefits a subset of those investors.
Very good. Well, thank you, Josh. That was very illuminating. So Dylan has a really fun and interesting life because he gets to really play around in the world of Silicon Valley, technology entrepreneurs, the nascent market here in New York that is called right now Silicon Alley. I think we're trying to come up with a better name than that. It's a little too derivative. But let me ask you, so efficient, sustainable, livable, these are the hallmarks or the buzzwords of urban planning, dreams of the future urban lives. What do VC investors, angel investors, early stage investors see arising from today's entrepreneurial efforts? What would you like to see also?
Well, so as you think about the venture capital world, it's high leverage. We've talked about debt financing. There are a whole series of equity financing of project equity, public equity, private equity. At the top of that would be venture capital, which is the riskiest but also making the highest return. So a venture capitalist, in order to make the 20+% compound annual return after expenses that they're selling to their investors, they need to look at each company as having the potential to return 10 times their money, because they know several of them will fail, several of them will be a sort of a wash. And so they can only look at really high growth, very scalable approaches. The information technology revolution has been wonderful for this, because if you connect a bunch of people together on the internet, they do all the work. All you do is rent some servers and create the connections and serve them advertisements, and you've got multi-$10 billion companies. The venture capitalists made a lot of hay when that was going on, built a lot of really interesting large companies that connected people, that did search for people, that allowed people to do online shopping. And so the VCs then launched off into deciding they would cure clean tech. And they'd use the same methods they used for information technology. And that didn't work out so well because those are big, long-term, high-dollar projects. There are a couple of notable successes in Silicon Valley in kind of big iron companies. And I've had a little bit of involvement with them with SpaceX, Tesla, and Solar City. Now, I'll observe they're all run by the same person, Elon Musk, so that maybe he's the anomaly. But a lot of VCs have gone back to say, well, what can we do that's a value add in these systems that's software-based? And so what I've started to look at, and what a lot of VCs have started to look at, is this idea of intelligent infrastructure. And the idea is to take an existing piece of built infrastructure and make it intelligent by the use of sensors, collect some data, do some processing, and then be able to have some sort of an impact with an actuator or by sending out information in order to improve that system. And so the story I like to tell is about the Marriott Hotel in Times Square. When they built the hotel, they miscalculated and they didn't have enough elevator capacity. A big hotel, but they also had a lot of meetings, and they had a restaurant on the top, and they just miscalculated. And that's a runaway problem, because if you get too many people in the elevator, they wait, there are more people in it, they press more buttons, it takes longer, the next people wait even longer, and it was 20 or 30 minutes to get an elevator at peak times. And so they looked at plans including building additional elevator shafts on the outside of the building with umbilicals connecting them, and just massively disruptive and expensive. And then a European elevator company came to them and said, well, we have a technology called destination elevators. And instead of buttons in the elevators, somebody walks up and they press they type what floor they want to go to into a keypad, and a letter pops up to tell them which elevator to go to. They walk to the elevator, they get in, there's no buttons inside. It takes them to the floor. So you can parse people out, you can have express elevators, you can use whatever algorithms you want to utilize those elevators most effectively. They put these in, this is sort of the early 2000s, and it literally solved the problem. This wasn't free. It was new elevators and some computers, but it certainly wasn't tearing new elevator shafts down the middle of a building or building space elevators on the outside of a building. So there are a class of solutions that appeal to venture capitalists because they can be leveraged, they can be built with small capital needs that can help cities perform better with the infrastructure they have.
And by the way, those types of elevators, I don't know how many of you live in New York or in big cities where you have skyscrapers, but those types of elevators are now ubiquitous across New York. My office is at 7 World Trade Center. It took me a while to get used to that. I kept jabbing the wrong buttons.
Every building you build, if you can build 20% fewer elevator shafts
right.
if you use these destination elevators. So This obviously applies to smart grid, to water systems, smart traffic systems. It's cheaper to use a system to sequence drivers than it is to build a new bridge or put another lane on a highway. So there are a lot of interesting solutions like this for the urban future that I think venture capitalists have gotten excited about and plan to make a lot of money on and have made a lot of money. I mean, Uber is a company that doesn't actually own anything. They have some employees writing some code, they have some servers, they have a network, but they're bringing in drivers as contractors who bring their cars and provide a very carefully orchestrated service that carpets many of the cities in the world with a highly reliable transportation system. That's where VCs have been putting their money, and I think there's a lot of benefit to be had in these smart technology systems as cities get more bathed in data and more instrumented and start to have more sensors and more feedback. You've got a city with the large majority of the people have a smartphone, have a computer interface in their hand that would allow you to interface with them in the way that they use the services of the city.
So my next group of questions for you then, Dylan, what are some of the problems that VC and private capital investors encounter when they're trying to evaluate urban infrastructure investment opportunities? And what's been the traditional model? Do you see the model changing at all? What are the mechanisms for paying for that?
So I think it's evolving. Initially it was hardware oriented, and I can tell about a very interesting company that I've worked with for a long time that's been through some of these evolutions. But in the same way you think about drones, I don't think drones are interesting. I think what you do with drones are interesting. I would never invest in a drone company because that's going to be a total commodity. Like there'll be, like these little hoverboards you see. That the Segway was the coolest thing ever. It cost $5,000. It was an amazing self-balancing thing. Now for $500, you can buy this little thing that your kids stand on, and you can buy them from 20 different Chinese companies that you don't even know the name. So it's commoditized. That the hardware gets commoditized, it's what you do with it. I thought Mitch gave a great talk about taking this data and doing something interesting with it. If you can integrate some of these systems into the city and simply take the data feeds and then do something useful with that, that can be wonderful. I worked for the company and have worked for this company for many years that does gunshot location. And technically, it's a very simple, clean concept. You put up microphones around a city. The microphones are located exactly. And when you detect a gunshot with the acoustic signature, you do an acoustic triangulation. You do the time of flight and the time of arrival by GPS of the wavefront of the sound at each of the microphones. And if you get 3 of them, you have a triangulation. If you get 4 or 5, you have a better fix. So they locate a gunshot, they process it, and then 15 seconds later, a red dot pops up on the 911 dispatcher's map and says, 3 shots were fired at this location. If it's a moving car, it can actually tell you what speed and direction the car was moving when the shots were fired. So this is wonderful. Of course, the city should have it. But in getting it installed, it was incredibly difficult. First, to get it paid for of the payment cycle. Many of you were using federal grants to do this. Then you had to find locations to put the sensors. You had to rent telephone poles or rent buildings. You had to work with the city to figure out the data, whether it was Wi-Fi or phone lines. And that was a very long and drawn-out process. It was also expensive, and the cities couldn't pay for it. So we actually, the company raised more money and operated at a painful loss for a year or two to transition the business to a service business where they actually rent the system to the city rather than having the city pay for it because the city couldn't find the capital. This has come to the next evolution now, which is the company just signed a deal with General Electric, and GE is making these smart lampposts, which they're hoping to sell all over. They're starting to be in Jacksonville, San Diego. They've got lots of sensors built into them and Wi-Fi. And in concert with this company, ShotSpotter, they put microphones into the lampposts also. And these microphones can be used to do the gunshot location. And so essentially, we will get to the point when these lampposts are more widely installed around the country and the world where we won't have to install any hardware. We'll use existing hardware and sensors, and we'll be able to do the processing and sell the smarts of our algorithms that do the acoustic triangulation, the recognition, the corrections for all the oddities of sounds in a city, rather than be in the business of driving around installing things on the top of telephone poles.
So that's an interesting story, because that leads a little bit into my next question then, which is in the instances where cities have installed these sensors, who is going to be able to access that data? You have people who want to access it for good reasons, as well as people who would want to access it for bad reasons. Who's going to own the data that these systems collect, and what are the privacy and security concerns around that?
I mean, those are thorny, and this company has many times run into the issue that privacy groups say, well, you're recording everybody all the time, and they tend to be higher up. They're very low gain microphones, because a concussive event is very powerful, and you only need to record that threshold. But that's an issue. They actually see this as a positive. One of the things they'll do is not just the gunshot location, but they'll do analysis, and the police departments, the ones that are honest about trying to do good policing, not hide the fact there are more gunshots than they actually say they are. They collect this data, and they actually go to the neighborhoods. If there are a lot of gunshots, they make little door hanger tags that they hang around the neighborhood saying, we've heard the gunshots, we know this is happening. That helps the residents. They put the warning out to the people firing the guns, saying, we know you're here, and we know that you're doing this, and we're going to have more policing. So that's a good use of the data. It's always a question of who owns the data. In a lot of these companies, the data ends up being the most valuable thing that they own,
right,
because they get commoditized out of everything else. And we actually at ShotSpotter view this national gunshot database as something very valuable that governments and private groups will be interested in having access to. The city of New York collects a huge amount of data, and they have quite a good open data program, but it's not everything, and they do have to deal with a lot of privacy issues. But that's anyone who's going to do business with the city has to figure that out,
right,
and has to be sensitive to the fact that some city data will not be public, and some data they won't be able to own. They'll have to give up in order to do business in municipalities.
Okay. So, and I want to go back to a point that you had made when we were talking a little earlier before the panel, which is, certainly we have this enormous public bond market, capital markets capacity, and then I think from the smaller private investor perspective, deals are going to get done if it makes sense, if people think they want the product, and if you can describe that dynamic a little bit, I think then we'll wrap up and leave time hopefully for a little Q&A.
Well, I think venture is, it's the seed money. It's the money that gets the idea started, that finds the smart person with the right idea and moves them along. Uber is if you believe the valuations, Uber is a $50 billion company. That's about the size of General Motors. That all came from a few $100 million worth of venture investment. And the idea of the venture investment is it's a small amount of high leverage dollars, and then that begins to attract lower risk money as the company grows. Presumably at some point Uber will go public, and it'll begin to use public equity to build out its system. A company called Square went public yesterday. They do the payment collection. They make a little white square that you plug in the headphone jack of an iPhone, so anybody at a farmer's market or a flea market can take a credit card. That's a very interesting company in that empowers transactions and selling in a very beneficial way. And they were able to go to the public markets and raise almost $100 million of public money to continue to build that business. It's a question of climbing up that chain of risk and capital to attract more public capital to scale businesses and grow them larger. But the venture will always and should always be a very small part of that. When it gets too big, they start doing stupid things like investing in multiple publicly traded online pet food companies. Sock puppets as their mascots. We'll try to do that again.
Well, great. Well, listen, thank you all very much. I think I wanted to just close this on a note that, when you look at the needs of urban centers, and it can look incredibly overwhelming, but it's also very reassuring that the depth and breadth of the U.S. capital markets can finance this. It's a question of will. So with that, I'll open the floor to questions.
Yeah, I'm just curious, what happens to the regional plan and to long-term municipal investment in this region if the polar ice caps start to melt a little faster than anticipated, and if we have a 2050 perspective and we're starting to face 10 more feet of water, maybe more than that? I know the ultimate projection is what, about 150 feet if they all melt? What happens to all our plans if that starts to be on the horizon as a possibility?
Right. Well, I say the most obvious answer is that we have to build that into our plans now. That these, we don't know. We know it's going to happen. We don't know the rate that it's going to happen, and we don't know kind of the storm and disruption aspect of it. But I can tell you what we're doing, to kind of factor that into the plan. Once we're we're looking at different types of strategies that you can do for the most vulnerable areas and the most vulnerable communities. Everything from from really heavy investment protection, like building a storm surge barrier, such as what they have in in the Netherlands and other cities, to retreating from the coastline for it, where you get the and that's a solvable problem when you have relatively low density areas. When you get to places like Lower Manhattan or very poor communities like the Rockaway out in Queens, it's a really tough thing. Are you going to actually try to move people off of those areas that have that were essentially put there because that's where you put the public housing in New York City? And I think we have to look at it. It's a long-term problem, and I think you have to look at kind of an evolutionary approach to it. So you have to have a very intentional strategy for different places that are most at risk, but you have to look at how that's going to play out over 50 to 100 years for it. And it's not easy by any stretch of the imagination, but that has to be factored into any type of long-term plan that we're looking at.
It's also, there's an interesting spending question. We've had this discussion that there's sort of two approaches. You can do broad resiliency work, or you can build a big piece of earthworks like a storm barrier. We had the storm, it did $20 billion worth of damage. We're going to spend another $20 billion worth of resiliency work. That the actual barrier only cost about $20 billion. So if you can develop the political will to get out ahead of the problem and do that, you might be able to avoid some cost. But the saying goes that cities usually get flooded twice before they find the political will to dig up the money and build a storm barrier. And London was not smart enough to do this before anything happened. They had two terrible events, and that's what encouraged them to actually build that infrastructure.
In terms of the value of your long-term bonds, I think that is a very large long-term risk. I don't think you'll see it show up in the price action of your bonds in the next 5 years. I think the pension issues facing municipalities will be more of both a long-term risk and something that will show up potentially in the price action over the next 5 to 10 years, as well as the growth rates of the region. But for the longer term, it's obviously if this was happening and the seas were rising and we weren't addressing it, that would deteriorate the value of, for example, an MTA bond whose assets are below that sea level.
Thank you for the discussion. It's been great. So I know we focused on New York City and the United States, but I've heard a few mentions of exporting innovations that we have, whether it's how we do municipal bonds, exporting that to India, or whether it's exporting Uber to Russia. How do you see kind of our bureaucratic, technological, financial mechanisms that support these advancements kind of spreading globally? And what are the barriers to entry for those things? Because we've spent 2 days talking about the many, many mega cities that are out there and all the secondary cities that'll have 4 or 5 million people in them. Clearly, whether it's a financial mechanism that you've built or whether it's a new technology or a planning strategy, how do we kind of export those things, or should we even be thinking about that?
I'll take a stab at that also. I mean, so some of the work that I did when I was an investment banker, for instance, I was in Mexico looking at a mortgage company, and what Mexico had done a lot of interesting work under Calderon and Fox, but one thing that they were missing was a really solid land title, chain of title registry, and this is true across many, many cities across the world. It's a huge problem throughout Africa. And Africa is growing, and will continue to grow by leaps and bounds. It's really the dynamic future for the world with the youth population. So the IMF, for instance, is starting a program where they're trying to get land registries set up. When you buy a property, when it's new construction, you're not that worried about the chain of title. The problem is when you try to go sell it, you can't develop a secondary market for resale without chain of title. And so there are issues like this that we take for granted in the United States that make it very difficult to then scale commerce and capital in developing markets. But they are starting, so that's one example.
I mean, we're actually doing something with the World Bank to try to have an exchange of kind of best practices and principles, both between developed countries and regions and developing ones. And what's interesting is that it's a two-way street.
Yes,
absolutely.
Absolutely.
And I think the big, when we kind of cut to what we actually can provide and learn to them, it's not the technology stuff so much, because that's going to happen. It's this institutional, it's the legal frameworks that are so tough to put in one place or another. And the same token, I mean, we're envious of places that, kind of don't have 100-year-old technology built in and that are actually kind of went, straight to personal communication technology vehicles, and what can we learn from them about how to use that and how to organize these places. So I think it's really kind of the the cultural exchange piece that we have to try to, just really thicken as much as possible.
The rest of the world's ability to build infrastructure has surpassed ours. And so we actually need to learn from the rest of the world how you build modern infrastructure again. These big infrastructure companies that build bridges and hospitals and everything, basically, they come in and build it for a government. Some of them don't like to work in the U.S. because it's too complicated and hard. They'll go to a third world country where the process is much clearer. And so we've got some impediments in place that we need to remove in order to get back in the business of building infrastructure. I think definitely from a technology standpoint, that's totally right. Countries that don't block our basic technology companies are adopting those technologies, and they're willing to spend for them. This gunshot location system, selling it as a service was a U.S. problem. International customers pay cash up front because they see a value in it and they just buy it.
But I think good ideas will transmit themselves. For example, variable rate pricing underscores Uber. If you're standing on 8th Avenue where there's a taxi on 7th Avenue and you want to find each other and you don't see each other, that's not efficient. If you can have an iPhone app, variable pricing, I think is actually an economist at Columbia that did the groundbreaking work that led to variable taxes for tolls, and the city center in London is using that. Bloomberg tried to introduce it here. I think it makes preeminent sense. You'll get a more efficient use of your resources if you have variable pricing. I think the economist, he was a grad student at Yale, and he noticed that when he was coming into New York on end the day, all the commuters were going one way with a full car, and he was going in an empty car. And he thought, gee, if they just lowered the price, some of my other grad students would go to a bar in New York City, but they can't afford it because they don't have the money, and it would be more efficient use of the resource. So I think good ideas in the bond market. It makes more sense to finance through a capital market than through a local bank market. China's studied our market, so have a number of countries in Europe. If you can only go to the local banks to finance, the pool of capital they have is much less than the global capital markets. So you're going to get a better rate if you can expand that. If you buy a certificate of deposit at your local bank, you're not going to get the best rate versus if you go to Charles Schwab or E-Trade and see 200 banks offerings and pick something higher. So I think these types of ideas for, when they work, they get copied even without us having to do anything. People see them and they export themselves.
There's an interesting example, too, though, of a country that completely remade itself, and that was Rwanda. And so Rwanda ended its genocide, and then it remade its business environment. And what was interesting to me about it was they almost treated it like a financial roadshow. In fact, they literally did. They literally went on a roadshow. They hired a London-based PR firm who basically took them on a roadshow around the country and around the world to get Rwanda onto the forefront of investors and business people and people of influence. And it was hugely successful. But that was a country that completely transformed itself from a pariah of the world into a country that's viewed as a very business-friendly atmosphere in Africa. Now, some of that's at risk depending on what happens politically there, but from a business transformation perspective, it's just an astounding story. Is that it?
Thank you, Adrianne, and this excellent panel for the great session today.